Hello and welcome to ByteTree's weekly, what do we call it, update, roundup, review, something. But whatever it is, it's not investment advice. Tom, how are you?
I'm brilliant. Thank you very much, Charlie, for that intro. Looking forward to this week.
Yeah, well, it's been a calmer week than last week, hasn't it? I mean, last week we'd just seen this sort of nail-biting turn in the market from 30 to 40,000. And we stabilized around 40,000 Bitcoin price. What's your take?
Well, I just think it's fantastic that we've seen support there. I was slightly more bearish. I thought we might see mid-20s. And actually, I think you could probably touch more on the Bitcoin side, but from a wider market, if we think about Ethereum and other Web3, it's been good to see people move away from shitcoins to infrastructure and layer 2 solutions, etc. I know we were talking earlier about scale and how they've reached a relative high. So I think that's really, really bullish, because I think as people enter the market, it only takes them so long to see the good stuff and not the bad.
Yeah, I just noticed by running through some of the altcoins, or shitcoins, you politely describe them, there haven't been any catastrophic failures that I've discovered. Everything's sort of staying in a tight group. And back in early 2018, there was no doubt some of them went straight down, and we're just not seeing that this time. So you kind of makes you want to believe that there's something behind this whole thing. And some of the protocols out there are seriously impressive, aren't they?
Oh yeah, exactly. And I think for the first time in the sort of cycle or two cycles I've seen, it's the first time that Bitcoin's dominance going down hasn't been totally a bearish signal. There's some good protocols out there, Maker, etc. Obviously, DeFi blue chips are always good. So it's good to see that yeah, some good people are in the space now, and there's some professionals out there.
Absolutely. So I just want to remind everyone that please put your questions into YouTube now, and we'll get to them shortly. We're just going to run through my commentary from yesterday and talk about some of those things. Maybe we'll get the odd altcoin gem out of Tom, and then we'll go to questions. So we'll kick off with the piece I wrote yesterday. And really it was talking about the Bitcoin flows, and hopefully we're going to get the tech right here. So Mark's going to bring up some charts for us to see. And we're kicking off with the gold flows, and the bottom line is that the gold market saw $40 billion invested up until September time last year, and starting at the halving was where I started the Bitcoin story in May, about 2026, I think, from memory. And Bitcoin started with nothing, and then went all the way up to 10 billion as of this week. Over the last year. So that's like 10 times more than all the previous inflow from institutions put together. And I sort of made the point that gold's a big market, let's call it $12 trillion. No one really knows the number. And Bitcoin, when the breakout at 10,000 began, Bitcoin was under 200 billion dollar market. So like for like is, it's a bit like shoveling $80 billion into the gold market is what happened to Bitcoin at that point. And since then, even more money's come. And I think the problem was in early May, we've started to see those flows turn down in Bitcoin. And at a similar time, the flows in gold started to turn back up. Clearly, when the Bitcoin rally began last October, that was boring for the gold market. It meant that the world was great. And if the world's great, who needs gold? It's only when the world's terrible that you need gold. And so investors sold a lot of gold funds and bought a lot of Bitcoin funds. I mean, what do you think of all that?
Yeah, just to touch on that, I'm thinking from your article, it's a fantastic article, by the way. And I'm starting to think that there's more of a from a macro perspective, there's a much bigger outlook you can get from simply looking at the Bitcoin flows and the gold flows. You touched on them both being hard assets, but it's clear that sentiment around the world economy really does affect where the money's going. And so, when probably a couple months ago or maybe 6 months ago, when everyone is in fear of the world, that, like say, gold gets the money. And then when we move on a bit and everyone's a bit safer and wants to take a bit more risk, Bitcoin gets the money. And I think that's an interesting pairing, because for quite a while, and to be fair, you've been shouting this for ages, Charlie, Bitcoin and gold are complementary and not competing. And I think like your charts perfectly show that.
Good. Well, I think they are complementary. It's very clear. Well, we know from years of information how gold responds to monetary conditions. Bitcoin's too youthful to have relationships like that, or at least to the same level of precision. But there's some sort of relationship. I mean, it's, as I've written before, 95% of all Bitcoin's gains have occurred when the bond yield has been flat or rising, and when inflation expectations have been flat or rising. So there's no doubt about it. And unapologetically, Bitcoin is a risk-on asset and has a lot in common with internet stocks in general. I think it's probably detaching. Well, I hope it's detaching for the second time. I mean, obviously, it did that a few months ago, didn't it? In December or so, when I highlighted how Bitcoin was taking off relative to internet stocks, which had run out of steam. But I think this time, I really hope they start to go on a different path, because that will make the whole crypto space more credible. And I suppose I just want to touch briefly, I didn't mention this week, but stablecoins. I think stablecoins are $100 billion, having been $20 billion at the beginning of the year. I find the whole stable thing fascinating. I mean, people are talking about the launch of central bank digital currencies, but it's like, okay, well, these are private bank digital currencies. What's the difference? One with fewer rules, but there's lots of it, and the world laps it up. I mean, what do you think about Tether? And I mean, without going through the whole sort of FUD of Tether, but the circle, the stable coins, and the issuance and the implications for the space.
Well, I think it shows complexity in the space, really, and how we're growing into an ecosystem rather than sort of a gold rush type thing. So stablecoins just play an amazing role in the space as sort of if you want to take profits, or if you want to make your money work through yields or such things like that. And I think it really shows that we're sort of coming into this space of reserve assets and more speculative assets, and all into one under one umbrella. And I think we'll continue to see stablecoins grow and grow. I think people are probably more comfortable holding something that's like a dollar rather than whatever Shiba or Dogecoin.
Well, I saw someone recently who will remain nameless, but he was telling me that he was a bit worried about things, and so he'd gone to cash, but not that banking cash. I've only got stable coins because they can't be confiscated. And I thought that was interesting, that people will, in the same way people thought physical cash was a better bet than cash in a current account back in 2008. Maybe people will start to have the same view about stable coins, which is amusing. But I think it's good for the space if that view starts to emerge, and there's more and more trust in these stable tokens. Indeed, I think Pax Gold has now got $250 million in it. Now, gold's got, no one in the space cares about gold really, and so the fact that they've done no marketing and they've got $250 million is really quite impressive. So that's just going to be huge one day, I reckon.
On the stablecoin side, with especially dollar stablecoins, also helps when the yields are so high for DeFi. These are 4, 5, 6% a year. And essentially you're holding just a digital version. Private bank digital currency is perfect way of putting it, Charlie. And I think that really helps because finally, interest rates obviously falling, and I think people are looking for other ways to put their money.
So talk me through the interest rates on US dollar stablecoins and how they behaved over the last, the volatility of the last couple of weeks.
Sure. So if we just take Compound, for example, because it's probably one more people know about. So Compound is a lending and borrowing platform. And essentially, to touch on the interest rates, it's based around the demand for that coin. If we take Tether, for example, in a market where people are taking loads of profits, or they're looking for opportunities to use their money elsewhere, then your interest rate will rise, or the lending rate will go down, the borrowing will go high, because it's purely based around the demand. So recently, we've been seeing the interest rate, so the lending rate, going up, and the borrowing rates going down slightly. I
mean, of the issuance of stablecoin, the fact that you can get a 6% yield in the virtual world, and you get pretty much nothing in the old world. Is that a big reason for the growth in stablecoins?
Oh, 100%. And there's no it's no surprise that we've seen such a massive growth. As people have got more comfortable with the space, all they need to do is just open their wallet, put $500 in, have a go at compound, and it's so easy. And as soon as you get comfortable with that, why wouldn't you? In effect, obviously, these are risky platforms, but the longer they're around, the more credibility they get.
No, fascinating. Well, I want to move on to the Bitcoin performance by region. Now, Mark, if you pop that up, please. I mean, this is a really interesting one, and the chart is built by trading sessions. So I define Europe as 6 a.m. British summer time to 2 p.m. and then 2 p.m. to 10 p.m. is the Americas, and then 10 p.m. to 6 a.m. is Asia. They're not perfect, but they get the point across. And so Bitcoin's a summation of those three. You've made some money in European hours, loads in Asian hours, and the American hours have actually lost a lot of money. Although interestingly, America has bounced quite nicely. And the joke is we're trying to figure out how to launch a product that only trades at night on pretty much every index in the world, because it just seems to be that the trading hours seem to destroy value, and out of hours don't. I think this is something to do with derivatives. And Mark, if we go to the S&P 500 to demonstrate an old school market, and the bottom line is that the S&P's got more derivatives on it than any other index in the world, I would think, equity index. And so derivatives have a strong impact in dampening price volatility. People assume that they make markets much more volatile, but they really don't, because when the market goes down, there's always someone happy and someone sad, and when the market goes up, there's someone happy and there's someone that's sad. So you've got more liquidity as a result of having different opinions of the market, and many different opinions in the market. And so this S&P 500 one's just hilarious. This idea that when the market's closed, all the money is made, and when it's open, it's really the Sharpe ratio is awful. I mean, you don't make much money and you get lots and lots of drawdowns, but the rest of the time you don't have many drawdowns and you make lots and lots of money. So, what do you think of that, this time zone thing?
Well, I think it's absolutely fascinating that people around the world can have such differing views about one asset when we're talking about Bitcoin. And I think that we were speaking about this earlier internally, and actually the fact that with Bitcoin or with a crypto asset, it truly is 24 hours a day, 7 days a week, and a global market. And I think when you have that, it sort of even amplifies even the S&P chart there massively. And I think it's the first time I've seen that chart, Charlie. So kudos.
It's not my idea. I saw it on Twitter, but I recreated it yesterday morning. I saw it on Twitter a long time ago now, and I saw the Bitcoin thing. I thought, hang on, the penny dropped, and maybe there's a link, and maybe that's the sort of thought process behind it. And it doesn't work on FTSE 100, by the way, because the opening and the close are the same number, even if you can't realistically trade at that number. That's how the index is calculated. So you just get a flat line if you try and put FTSE in it. But I will, if I get around to it at some point, try it with other indices. But amusing. Sometimes you're allowed to be amused by finance. And so we're going to move back to the blockchain. Now, Mark, if we pop up some ByteTree charts, please, we'll kick off with fair value. And the fair value basically is built around spend. It's the amount of money that transfers over the blockchain. At the moment, it's around 68. I think it's $68 billion a week. The last time I checked, so just under $10 billion a day. We link that. We basically link that to the market cap of Bitcoin, which we do the adjustment. We take out the inventory of 1.5 million Bitcoins that have never seen the market, and then recalibrate it. And you end up with a fair value, and it's our fair value has consistently been saying this year 38,000 Bitcoin. Where are we?
38,000. Oh, no, we're around. Yeah, we are 38,000. Yeah.
Well, there you have it. There you have it, Tom.
Wow. What an indicator.
Where's the Nobel Prize? Anyway, this methodology I came up with, 7 years ago. And there's a bit of cheating because we allow ourselves to recalibrate on a 2-year rolling basis, which I think makes it a bit more accurate, because you have to accept the fact that the number of active coins is something that's changing over time. So you can't assume that 17.5 million Bitcoin or 17 million Bitcoin are all the same and they're all flying around at the same rate. Some of them are lost, some of them are long-term hodled, and others are whizzing around the derivatives market at the speed of knots. And so you have to sort of account for the fact that the market is changing. And but the bottom line is the link between blockchain dollar activity and dollar price of Bitcoin is a robust long-term link. Now, the 12-week average that we use is the best one in a sideways market. It's the worst one when the market's on the move, because it's always going to be a bit behind the curve. Obviously, the 1 week's going to be the most sensitive and the one that's going to be on it. But it's slightly saddened to see that the fair value at the moment has dropped considerably over the last few days. Blockchain activity is slow.
Just to touch on that point, and the idea is just coming to my mind. When you have such a flush out of liquidations, people's leveraged, good or bad, 100 times that leverage on FTX with a market moves like this is bound to flush people out. Do you think that we come back more to the fair value as leverage gets flushed out of the market?
Probably, but I think that the important point here is when you've got a sort of bubble conditions, which by that I mean the sort of post-Musk environment. So really from early February, the whole thing became like GameStop. The whole thing went nuts. Wall Street Bets and that lot took over, and so sensible comment really wasn't particularly important, and it was all about yeehaw ramping. And at that point, you just have to wait for it to pass, and it always does pass. I mean, 10 out of 10 times hype passes. And so if you know that, then you just have to, be a little bit patient and know that these things will come back. But now I'm much more concerned about the fundamentals than the price, because the price will be where it deserves to be in the long run. And so, keeping the network busy is an important point. And that's what we're going to look at now in the next couple of slides. So we'll move on to the premium quickly, just to finish off the fair value concept. And Bitcoin did go into cheap territory relative to the 1 week valuation model last week. It's not high, but I don't like to see the baseline falling. And so that's going to send the premium up quite quickly. And we know from observation over time that basically whenever the premium is sort of above 50, 60, then that's not a great time to be in Bitcoin compared to when it's low. Of course, the lowest numbers we've had were in March last year, when we had this 50% below fair value, and what a time to buy that was. So they do come around from time to time. Then the other thing is number of transactions. So Tom, I want to bring you in here. The number of transactions in Bitcoin, it's never been over 3 million a week ever, because the blockchain basically runs out of capacity. And we're now looking at, 1.7 million, I think it is. And it's sort of, given the state of the market, and let's face it, this year has been a very good year for Bitcoin. It's pretty low, isn't it?
Yeah, well, I was thinking that actually. And I was wondering, I think that really touches on who is in the market at the moment, and what it means for, these are tiny transaction numbers, and we often talk about a network value, or the network effect. And when you have so little activity, I guess is how you could look at transaction count. It's a bit worrying, and it does make you wonder where is the support coming from, and I can't see the transaction value numbers, but I imagine they've fallen quite steeply as well.
So there's a few things going on here. We've had the Chinese mining outage, and Mark, we move on to block interval, and then Mark, just to give you the heads up, we'll go back to IDR afterwards. But the block interval has gone up. It's 10 minutes per block, 600 seconds, and if the number of miners, if the miners go on strike, the number goes up. and to 750 seconds. We've seen that twice this year. In fact, we saw it in November as well. That was short-lived because the market was itching to go. But what's happened this time is that the sort of blockchain capacity has fallen. That makes it more expensive to transact because there are fewer blocks to transact into. The adjustment now comes on Saturday night, and that will make it much easier to mine Bitcoin than it currently is. A downward adjustment of, top of my head, 20%, something like that. And that should bring the fees down. And that's good for transactions. But all in all, some of our models don't like lower fees. They because higher fees are a sign of a buoyant market. So there's a bit of conflict going on now, and I think it's good that the mining is going to stabilize over the weekend. But I really hope it sees the traffic pick up. And would you have a comment on that? And then we'll go to IDR.
Yeah, well, I think for the first time. First time I've seen such disarray in the mining sector over the last 6 months probably. We had the Chinese FUD, and also I'm not really sure what's going on there really. Normally you see such a volatility in fees on Ethereum because all the applications, but for some reason Bitcoin's experiencing the problems. And I want to just touch on your the sweet spot for fees, because we've seen too low, we've seen too high. With too high is normally around 6 to 8% of transaction value, I believe. And I just want to see what can bring us back down. And just one more thing, Taproot. So you said the difficulties adjusting on Saturday, and actually something I wouldn't say no one's really talking about because I wrote an article on it, but we're in the next 2016 blocks. We're gonna try, or I say we, the Bitcoin mining community is going to try and push through an upgrade called Taproot, which is going to greatly increase the amount of transactions that we can actually process. So hopefully, in the long term, the transaction count will naturally go up through this upgrade. I just thought I'd touch on that because people often disconnect Bitcoin from the actual technology and the on-chain behind it. And I think it's important to realize that something's happening behind, what seems to be the old coin in the space.
Absolutely. And I think the point I'd add is, over the next 2 decades, in 100 years, 100% of miner revenue is fees, right? And most of that comes within 2 decades. That shift, I think it's over 75% or something. So fees are going to be a lot. And by my simple calculations, if you maintain the current levels of transactions and the miners want to be paid the same as they are today, then in 100 years' time, a transaction is something like $300. So that is an issue. And so solutions like Taproot coming along are going to be ever more important. But of course, people are saying that Bitcoin is now monetary. It's the monetary asset of the crypto space. So you just settle at the end of the day. And if you've got loads and loads of activity and you settle once for $300, well, so what? So, and I sort of agree with that. And then other people would say that actually the miner revenue is cheap compared to the traditional financial system, which has loads of skyscrapers and private jets and you name it. So there is that. But we'll just have a quick, just to talk about IDR quickly, the institutional dominance ratio. What we're doing here is taking the highest quintile of blockchain traffic, comparing it to all traffic, and seeing how big it is. And it averages 99%. Now, in 2018, this dropped much lower, and we'll be able to publish that data fairly soon. But the bottom line is that when it's falling, it means the institutions are getting bored, and the big tickets aren't going through. And when it's rising, it means they're really squeezing the price. And so, again, that was another one of those indicators that's been falling in May. And we're now down to just above 99%. So I think that's another one to be watching. Will the institutions get bored? Quite apart from our flows. So our flows are really telling you which asset allocator is investing in Bitcoin. And then that's a sort of buy side, if you like, the fund manager side. The sell side, the broker side, is more reflected more accurately through IDR. And so that needs to stay up too. So there's quite a few things happening at the moment, aren't there, that we need to stay on our toes.
Yeah, no, just to touch on that, it's good to see support at 30, but from just a couple of the metrics we've touched on now, we need to see them perk up slightly. And I think we're always talking home about institutional involvement, and we really want to see. We don't want them to get bored, that's for sure.
Right, we'll move to questions now, Tom, and then before we'll wrap up shortly. But talk about NFTs has gone quiet recently. How do you see the space evolving over the next 6 to 12 months? Which industries do you think it could be the most beneficial?
Well, just to touch on this, on the second point, on the industry side, actually, Mark is very involved in the music industry, and we've had many internal conversations around royalties and actually how musicians can really benefit from having royalties or having royalties online. So I think that's an industry, probably one of the biggest, but hasn't got the the spotlight as much. Obviously, art is brilliant. And actually having art in a digital form is, although typically when someone sees that, they go, well, it's digital, I could just take a screenshot of it. But there's much more, overarching things behind that. And it has gone quiet recently. I mean, not too quiet. NBA Top Shots is still doing really well, and NBA Top Shots is a sort of online trading card game for the NBA, the basketball in America. But I think people have been put off by just incredibly crazy prices. And I think we'll come back. It's a very new space. And when you have a new space, you get the hype and people get scared, lose money, and then we'll start coming back to the fundamental side of it, and actually why unique assets on the blockchain are really, really important, and something in the long run will be massive.
Well, I was listening to a podcast today called the Money Maze podcast, and it's an ex-city boy who set up a wine, an online buy-sell fine wine business, and it's very successful. And there's a two-way spread on all the major Bordeaux and so forth. Well worth listening to. Money Maze is the name of it, and he's developing blockchain technology, and they're talking about fake wine. We know when you've got a bottle of wine that's worth 10,000, 20,000, then people take the old bottle, refill it with something quite good. They're not that good, and there's some fraud in the system, particularly in China, less so in Europe, he was saying. But he wants to engage with blockchain with this sort of thing. I'm not sure if it was NFTs would apply in this case, or whether it was just the provenance of the cases and where they are. Because they've got a limited supply situation, and the good stuff gets drunk and it gets older and it gets more valuable, there's less of it, all that kind of stuff. But of course the market's much less liquid. But he's also making the point that every year, whatever happens, there are more millionaires than there were last year. And so therefore, and wine just goes, wine just gets drunk and drunk and drunk. So therefore price go up. So I thought that was quite interesting. And it was a real world sort of application of where the whole technology is really pretty interesting.
Yeah, and just to touch on that point, maybe the certificates on the wine, that they could NFT that. Essentially, you're immortalizing an asset on the blockchain, and there's so many use cases where that's pertinent. And the other thing, we probably touched on this maybe 8 months ago, Charlie, is diamonds. And actually, the problem with diamonds is that when someone says it's AAA, you're just going off their word. And how do you actually know that it's a AAA diamond that you bought? So what people do, or what they're starting to do, is they're NFTing the certificate for the diamond, and then you have your diamond when you buy that. So this is another interesting real-world use case.
Because diamonds are, of course, non-fungible, whereas gold is fungible. Bitcoin is fungible. One Bitcoin has the same value as another Bitcoin. 1 ounce of gold has the same value as another ounce. Also, you could have a Roman coin, which has got a historic premium, but that's another matter. And then last question, can we talk about the impact of the Chinese ban? Is it bad for security of Bitcoin? Is it bad for network effect? I think the ban he's talking about in this case would be, well, but there are two bans, aren't there? One is on something to do with using Bitcoin, and the other one is something to do with mining Bitcoin. Having watched all the Chinese bans over several years now, I'm never quite sure which one is a ban and which one isn't a ban.
Yeah, I think there's loads of Twitter people saying, "Oh, it's the 150th time they've banned buying Bitcoin." Well, I think the using Bitcoin. I think for some reason that just seems to happen when people are making loads of money. On the mining side, is probably more interesting for me. I think in the long run, it's good. And I think when you try to talk to an investor about mining or like about Bitcoin, you say, "Oh, people estimate, a large amount of mining's in China." You almost don't want to say that, but with this ban, it's good for renewables. Although I believe from my own experience, renewables is a massive part of Bitcoin mining, and also probably just good to make the network a bit more, decentralized from a mining sense.
Yeah, I think on the mining side, Bitcoin would benefit from more transparency. I mean, Satoshi's white paper envisaged lots and lots of people using their PCs, and didn't quite work out that way, did it?
No, too much money.
Everything else he got right.
Yeah, way too much money in the space.
Yeah. Well, I think, thank you for your questions. Bye-bye.
Thanks, everyone.